Hello and welcome to my channel. If you're new here, my name is James and I make financial education videos to help you invest smarter, not harder. And today is story time. And this is actually my favorite finance related story of all time, so you're in for an absolute treat. This is a story of four friends, Sally, Alice, Pete and Charlie, who were all saving and investing from 1977 to 2022. That's 45 years. They were all 20 when they started, which means they're all now 65 and ready to retire. And for those past 45 years, they've been saving £50 every single month. Three of them decided to invest their money into the stock market, and they knew the benefit of diversification, which basically means not putting all your eggs into one basket, or not putting all of your investments into just one or a small handful of companies. So they all invested into the S&P 500, one of the key US indices that tracks some of the 500 biggest US companies. So they essentially invested into those 500 large companies. Now, of course, they couldn't predict the future and what the market had in store for them over the next 45 years, but they knew it wouldn't all be plain sailing. And sure enough, it wasn't. There were actually 5 main market crashes during their 45-year investment that you can see here. There was Black Tuesday in 1987, there was the Kuwait War in 1990, there was the dot-com crash which started in 2000, the global financial crisis in 2008, and of course most recently, the market crash caused by COVID in 2020. So our saving and investing friends were all the same age, they saved the same amount over the same 45 years, and for the 3 who invested, they even used the same investment. But they each had very different outcomes, as you'll come to see, and that's because the only difference was in their approach to saving and investing, how they actually did it. So, to kick us off, we have Saving Sally. Like her friend, she was able to save £50 every month, but she didn't really like investing. She thought it was too scary, too risky for her, she didn't understand it, she thought it was only for extremely rich people, and so every month she put her £50 into the best savings account she could find, which paid her 3% a year. And after 45 years of doing this, she's ready to retire and has a pot of £57,019. Now let's put her data on the graph. Now, this isn't just a straight line because she has more in her account, she earns more interest, and that's why you see this slight curve. Now, next up is her friend Awful Alice. She saved £50 every month and put it into the same 3% savings account until she picked her moment to invest, as she was very keen on avoiding any market crashes. She thought she'd be able to time the market and make a killing. So when she thought it was a good time to invest, she took all of that money she had saved up in her savings account and invested it, and then continued saving her £50 into her savings account again until she thought the time was right. However, turns out she wasn't very good at timing the market. She was actually terrible, as bad as you could possibly be. She invested 5 times during the 45-year period, each time investing right before the 5 crashes we saw earlier at the market peak. But even despite having the world's worst timing, she still ended up with £309,297. She still did very well as she never sold her investments. She had money in the market working hard for her, in comparison to Saving Sally, who just had her market in the bank. Despite buying in at each market peak, her investments ended up doing well as the market recovered and far exceeded the point at which she bought in. Next up was Perfect P. He also thought he could time the market and took the exact same approach as Alice, saving into his 3% savings account until he thought the time was right. The only difference was that he was much better at picking his moments than Alice. He also only invested 5 times during the 45 years, emptying his savings account each time, but his market timing couldn't have been more perfect. He invested the absolute market bottom, the cheapest price after each market crash. Now, let's just cover off the point that you may be thinking, well, how do I do that? How do I perfectly buy at the bottom? And the answer is, you don't. To correctly predict the exact market bottom is basically impossible. Sometimes the bottom might be once the market's fallen 5%, 10%, other times it might have to fall 50% to get to the bottom. It's impossible to tell. Of course, being the perfect investor, it served Pete very well. He ended up with 44% more than Alice, with £444,865 to his name. But considering we've gone from having the world's worst possible timing to the world's absolute best timing, a 44% increase seems quite small, and it's because the growth they experienced on their accounts was mainly from buying and holding their investments, not their market timing. And lastly, the last friend we have is Consistent Charlie. He didn't care about trying to time the market, reading the news, keeping up to date with stock market, the prices and all that. He set up a regular monthly savings plan into his account of £50, never looked at it, never changed anything. That means that every month £50 would come out of his bank account automatically and be invested at whatever the price was on that day. So he'd be buying in at supermarket highs, super low prices, everything in between, every single month. So he saved the exact same amount as Sally, Alice and Pete, £27,000. That's the £50 every month for every year for 45 years. And when he looked at his account, he ended up with £735,720. That's 65% more than Pete, who was able to time the market perfectly. Literally doing nothing, the most simple strategy of them all, made way more than timing the market to perfection, which remember, we've already covered is actually impossible. So let that just sink in for a moment and ask yourself, does investing have to be complex? So what are the key takeaways from all this? Well, some of you may have heard of famous investing saying, time in the market beats timing the market, which basically summarizes exactly what we've looked at today and what you've learned. And now you can really see that principle in action. So if you're exploring the idea of investing, or perhaps you already are, and you think the market's too high, or it's dropping, or it's going to keep dropping, and so you want to wait, you are trying to time the market. In that scenario, just remember and think back to the story. Think of Perfect Pete and ask yourself if you can predict the exact market bottom as well as he could. And then remember, even if you can, you can't, it's still not even a winning strategy. Now, as you've seen in this video, I used a Google Sheet to do all of this, and you can actually download that to change the monthly investment amount if you wish, and also that 3% savings figure to whatever you want. I'll leave the link in the sheet in the description box below. All you need to do is click on that. Once that's open, click on File in the top left-hand corner, click on either Make a Copy or Download, and then you're free to play around with the numbers. And on that note, thank you so much for watching today's video. Don't forget to hit the like and subscribe button. It really does help me out and motivate me to make more of these videos for you. And also leave a comment down below about what you thought about the video and if some of these figures took you by surprise. And I'll see you in the next one.